Welcome back to the Deep Dive, everyone.
Right there.
And today we've got a special Talk Tickers edition for you.
That's right.
Because our mission here is really just to take the noise of Wall Street, all that corporate spin, and translate it into clear, actionable signals for retail investors like you.
Exactly. We want to cut through the jargon.
Right. And usually when you listen to a corporate earnings call, there's this underlying expectation of engineered corporate theater.
Oh, absolutely. It's usually very sterile.
Yeah. You tune in, the executives read their highly polished, prepared remarks. Analysts try to poke a tiny hole during the Q&A, and then everyone goes home.
Yep. Completely scripted.
But occasionally, you step into the world of industrial software during a massive technological shift, and that carefully constructed script just starts to crack.
Which is exactly what we're talking about today.
Exactly.
Yeah.
That is exactly what happened with PTC's Q2 2026 earnings call.
It was a fascinating call.
It really was. We are looking at a company that they just finalized the divestiture of their Kepware and ThingWorx businesses back in March.
Right, which were major divisions.
Yeah, two highly visible IoT divisions. So the immediate critical question for you when we look at these results is, when a company sheds major divisions like that, are they losing their edge and shrinking?
It's the classic question.
Right. Or, are they finally trimming the fat to get dangerously focused?
It really is the ultimate Rorschach test for investors. I mean, it always is.
Yeah.
Divestitures always trigger this initial wave of skepticism,
Sure, because you literally see the top line revenue drop.
Exactly. You see that mechanical drop because a piece of the pie is just gone, and your instinct is to assume the company is losing ground.
Right. They're retreating.
But reading through CEO Neil Barua's setup on this call, the narrative points in a wildly different direction.
Okay, how so?
Well, they are offloading the industrial Internet of Things, right? The sensor level connectivity stuff.
Right.
And they're doing it to focus obsessively on what they call the intelligent product lifecycle.
Ah, okay.
Yeah. They are stripping away the hardware adjacent distractions, basically, to double down purely on the data architecture.
Which kind of brings us directly to the first core segment today to figure out if this leaner PTC is actually a meaner PTC.
Let's get into the raw numbers.
Yeah, let's look at the Q2 headline numbers. I've got the transcript right here.
What stood out to you?
So Q2 constant currency ARR, that's annual recurring revenue, hit $2.388 billion.
Wow, that's a big number.
It is. And that is an 8.5% year-over-year growth rate.
Which is impressive.
Right. And that lands right at the high end of their guidance range.
And that's excluding the divested businesses, right?
Exactly. On top of that, free cash flow and operating cash flow both grew a solid 14% year over year.
That's the leverage right there.
But the capital return strategy is what really caught my eye.
Oh, the buybacks.
Yeah. So they did a standard $250 million common stock repurchase.
Which is normal enough.
Right. But then they took the entire $375 million in net proceeds from that divestiture we mentioned.
The Kepware and ThingWorx sale.
Yes, the whole chunk of cash, and they dumped it into an accelerated share repurchase program.
Yeah, let me translate that a bit for the listeners, because that is huge.
Please do. Break down the ARR first, though.
Sure. So ARR, annual recurring revenue, is basically the absolute heartbeat metric for a software as a service company like PTC.
It's the locked-in money.
Exactly.
Yeah.
It measures predictable recurring revenue. The fact that they hit 8.5% growth, excluding the businesses they just sold off, it shows the core engine is highly resilient.
Right.
And then that capital allocation decision you mentioned, the accelerated share repurchase, or ASR.
Yeah. Why is that so important?
It tells you everything you need to know about internal management confidence.
How so?
An ASR is a blunt instrument. You are handing hundreds of millions of dollars to an investment bank and telling them, hey, retire a massive block of our shares immediately up front.
Wow. So no timing the market.
Right. It removes the flexibility of trying to buy dips over the next 12 months. Management is effectively broadcasting that they believe their stock is way undervalued right now.
It really is like a company betting on itself at the poker table.
Right. That's a great way to put it.
Just pushing all their chips, all that divestiture cash, all in on their own stock.
Exactly. They're putting their money where their mouth is.
And hitting the high end of guidance in this tough macro environment. I mean, that is hard.
Especially for them.
Right. Neil Barua explicitly noted the headwinds. High energy prices forcing manufacturers to tighten belts, global uncertainty.
It's a tough time for industrial manufacturers.
It really is. So Achieving that kind of growth when your core customer base is facing an energy crunch, well, it suggests the software isn't viewed as a discretionary expense.
No, it's critical infrastructure.
Which moves us into the story behind the numbers.
Yeah.
Why are customers signing these massive checks right now?
This is the most fascinating part of the call. We have to ask why a massive manufacturer in Germany, facing spiking energy costs, would prioritize upgrading their CAD or PLM software.
Right, why not just cut the IT budget?
Exactly. And the answer lies in the core narrative Barua laid out. It centers entirely on the deployment of industrial artificial intelligence.
AI is everywhere.
It is, but he argues that the broader market obsession with AI is actually acting as a massive forcing function for PTC's legacy organizational tools.
Oh, really? How does that work?
The thesis is that you just cannot deploy fancy, advanced AI agents to optimize your manufacturing if your underlying engineering data is fractured.
He used a specific phrase that stuck out to me, actually.
Yeah.
He said, the strength of their product data foundation determines their AI ceiling.
That's the quote. Yeah.
So if I'm an investor hearing that, my instinct is to figure out what that foundation actually looks like.
Let's break it down in plain language.
Okay, so let's take a complex industrial manufacturer, say a company building commercial MRI machines.
Good example. Very complex.
Right. They have mechanical components, electrical systems, software layers, strict FDA compliance data.
Tons of data.
And my assumption is that over the last 20 years, that data hasn't exactly been sitting in a pristine, unified database.
Your assumption would be aggressively correct.
I figured.
In reality, the bill of materials for something like an MRI machine is just a chaotic web.
Like, how bad are we talking?
Oh, bad. The mechanical team might be using a legacy 15-year-old on-premise database.
Okay.
The electrical engineers might have their schematics on an entirely different server.
Right.
And supplier pricing, material compliance data that might literally be sitting in thousands of disconnected Excel spreadsheets scattered across different departments.
Wow. So when the C-suite of that MRI manufacturer decides, hey, we want to implement a shiny new AI agent.
Because everyone wants AI right now.
Exactly. They want it to automatically update supply chain logistics every time an engineer changes a specification. But the AI just hits a wall.
The AI completely fractures.
It can't read the spreadsheets.
Well, it hallucinates because it lacks an authoritative source of truth. It doesn't know if the Excel sheet on the procurement manager's desktop or the PDF schematic on the engineer's hard drive represents the actual current state of the MRI machine.
That makes perfect sense. So it just guesses.
Right. And you can't have an AI guessing on a medical device.
Definitely not.
This is the realization sweeping through the industrial sector right now. Before you can deploy AI, you have to undertake the painful, unglamorous work of migrating your messy data into a single structured system of record.
And that system of record, that's PTC.
Exactly. Their platforms like Windchill, Creo, and Arena act as that necessary data foundation. They aren't selling the AI itself as the main hook.
They're selling the mandatory plumbing required for the AI to even function.
Perfectly said.
That is a fascinating tailwind. It means the AI hype cycle is driving sales for software that PTC has been perfecting for years.
Decades, really.
And the earnings call provided specific, massive displacement wins to back up that theory.
Yeah, the proof points were strong.
Let's list them off. Starting with automotive, Barua highlighted a major displacement win with a leading automotive supplier using Windchill Plus.
That's a big deal.
And later in the Q&A, they specifically called out momentum with BMW.
The BMW context is crucial here.
Why is that?
Because the entire auto industry is transitioning towards software-defined vehicles.
Right. Cars are basically computers now.
Historically, an automaker managed physical parts, chassis, engines, transmissions. Now they are managing millions of lines of code.
Right. Code that controls the brakes.
Exactly. The battery management system interacting with the braking system. The complexity of product data has grown exponentially.
So they need a single platform.
Yes. Consolidating onto a platform like Windchill is no longer about marginal efficiency. It's about preventing catastrophic version control errors.
Like what?
Like where the software expects a sensor to be there, but the hardware team decided to remove it 3 weeks ago.
Oh, wow. Yeah, that's a literal car crash waiting to happen.
Exactly.
And that synchronization of hardware and software development is exactly what their application lifecycle management tool, Codebeamer, is designed for.
Which is another massive growth driver.
But the win that really illustrates the scale of this data consolidation trend was in the federal defense sector.
Oh, the Army contract.
Yes. The U.S. Army officially stamped Windchill as their standard PLM, product lifecycle management system.
That is a massive validation because when you look at defense logistics, you are dealing with the most complex sustainment challenge on the planet.
They can't even imagine.
The Army operates vehicle platforms designed in the 1980s alongside cutting-edge drone technology.
Right, all at once.
Managing the life cycle of a Black Hawk helicopter means tracking individual rotor components, material fatigue data, and knowing exactly which supplier can make a replacement part for a 40-year-old system.
And Barua framed this Army contract not just as a revenue event, but as a calling card.
Oh, for sure.
Because if the Army validates that Windchill meets the Department of Defense's insane security standards,
the draconian compliance standards.
Right, then it dramatically shortens the sales cycle for every other branch of the military and the private contractors who supply them.
It's a domino effect. The defense industrial base relies on interoperability.
So everyone has to use the same system.
Pretty much. If the Army dictates its digital thread runs on Windchill, then Lockheed Martin, Raytheon, General Dynamics, they are all heavily incentivized to align their own PLM environments with that standard.
Just to ensure frictionless data exchange.
Right. It's a systemic lock-in that creates a multi-decade revenue stream for PTC.
Incredible. And beyond heavy manufacturing and defense, they brought up an awesome case study regarding ServiceMax.
Ah, their field service management software.
Yeah. They ran an AI pilot with a massive industrial company, and Neil detailed how it initially struggled to gain traction when it was driven top-down by the IT department.
Typical enterprise software problem.
Right. But when they put the AI tools directly into the hands of the actual field technicians, the adoption curve just went vertical.
Because the workers proved the ROI themselves.
Exactly.
Right.
It evolved from a small test into a massive 7-figure standalone AI SKU deal just in North America.
That dynamic just exposes a chronic flaw in how companies buy software.
What do you mean?
Well, the C-suite buys software based on dashboard visibility, right? But the software fails because it creates friction for the actual end user.
Makes sense.
What ServiceMax did was solve a intensely frustrating problem for the technician on the ground.
Give me an example.
Imagine standing in front of a malfunctioning industrial turbine.
Okay.
Previously, diagnosing an obscure fault code might require parsing through a 500-page PDF manual on a clunky tablet, trying to find a torque spec for one specific valve.
That sounds miserable. A process that takes hours and halts production.
Precisely. But if the ServiceMax AI can instantly parse that localized documentation, analyze the fault code, and project the exact schematic and repair procedure right onto the technician's screen.
Oh, wow. The ROI is immediate.
Exactly. The technician completes the work order in a fraction of the time. The workers themselves end up demanding the tool.
Which totally circumvents the usual procurement friction.
Exactly.
And there was one more massive tailwind they outlined, tapping directly into the electronics and high-tech sector.
The data centers.
Yes, specifically companies rushing to build physical data centers for the AI boom. We tend to think of AI as just cloud computing.
Just floating in the ether.
Right, but the cloud requires millions of square feet of physical real estate, server racks, massive cooling systems, power distribution.
It's highly physical, and the companies engineering that physical infrastructure are facing unprecedented speed-to-market pressures.
And everyone wants it built yesterday.
Right, you have hyperscalers demanding 100-megawatt facilities on compressed timelines.
Crazy.
The hardware manufacturers building the cooling arrays are hitting structural engineering limits. So they are turning to PTC's CAD and PLM tools to run advanced thermal simulations and optimize their supply chains to meet this massive surge.
So it really positions PTC as the back-end infrastructure play for the infrastructure builders.
Selling the picks and shovels.
Exactly. But, okay, this brings up what I think is the most critical analytical point of the whole deep dive today.
Let's hear it.
Okay, so PTC is selling the picks and shovels for the AI data center gold rush. But wait, if everyone is building AI, what is PTC's actual moat?
Ah, the structural moat question.
Yeah, like why can't a generic AI model from a massive tech giant, say an OpenAI or Google, just ingest all these files and read them?
It's a great question, and it was actually raised during the Q&A.
Oh, it was?
Yeah, and Neil Barua's response centered on what he called their unfair advantage.
Okay, what makes it unfair?
To understand this, you have to separate syntactic logic from physical reality.
What does that mean?
Well, a general large language model, an LLM, is exceptional at identifying patterns in text, code, language.
Sure, it can write a poem or a Python script.
Yeah, right, because those constructs operate within a closed system of defined rules. So if you ask ChatGPT to optimize a paragraph, it understands the grammar perfectly.
Right.
But if you ask it to optimize the structural support of a concrete pillar,
It doesn't actually understand concrete.
exactly, it lacks the mathematical context of the physical world. An LLM doesn't natively comprehend 3D geometric math or material tolerances.
Right, it doesn't know how titanium reacts to heat.
Precisely. If you ask a generic AI to redesign a turbine blade to be 10% lighter, it might generate a 3D model that looks visually aerodynamic.
Oh, that's cool.
But because it doesn't understand manufacturing constraints, it might design a blade that is physically impossible to actually manufacture on a CNC machine.
Or one that just shatters under the stress of 10,000 RPMs.
Exactly.
So it's basically the difference between a grammar checker and a structural engineer.
That's a perfect analogy. The LLM is just predicting the next pixel in a 3D rendering based on training data without understanding the physics.
But PTC builds the underlying CAD software.
Right, Creo and their cloud platform Onshape. Their proprietary agents are the only ones that can safely navigate and alter complex 3D product designs.
Because they are trained directly on the underlying mathematical data.
When PTC's AI suggests a design modification, it understands how a 1 millimeter change in a chassis will mathematically propagate through the entire assembly.
It knows it will change the center of gravity.
Yes. Because they own the system where the math is generated, they hold the keys to the kingdom. General-purpose AI models just aren't engineered for that.
So a big tech company would literally have to build a new CAD engine from scratch just to get the training data.
Exactly, which is an incredibly difficult barrier to entry.
Wow. Okay, so with the sales team clearly humming, thanks to a go-to-market transformation they started 16 months ago.
They are definitely executing well.
Let's pivot to segment 3, management guidance. Let's look at what they expect for the rest of the year.
CFO Jen Dorigo presented some very aggressive forward-looking data.
Yeah, she really raised the stakes. Let me read off the new targets.
Go for it.
So she raised full-year revenue, bumped it up to between $2.580 billion and $2.820 billion.
Solid increase.
And raised EPS, earnings per share. Non-GAAP EPS bumped to a strong $6.65 to $8.90.
The profitability is scaling.
And for the immediate Q3 targets, they are projecting $40 million to $55 million in net new ARR, which is 8 to 9% growth.
But the metric that really needs some translation for the financial modelers listening is the free cash flow baseline.
Yes, the fiscal 2026 free cash flow guidance is $850 million.
Right.
But you noticed a crucial detail there for analysts, right?
Yeah, she explicitly instructed the analysts to account for a $100 million one-time cash impact this year.
Okay, so what does that mean in practice?
It means the true baseline to model fiscal 2027 growth from is actually $950 million.
Ah, so she's front-running the financial models.
Exactly. It's a very deliberate signaling tactic. She wants to ensure analysts don't apply their growth rate to the lower $850 million figure, which would artificially depress future price targets.
She is forcing Wall Street to model a steeper cash generation curve.
Which demonstrates massive confidence.
Which perfectly sets up the blockbuster announcement of the call.
The new buyback.
Yes. The board just authorized a massive new $2 billion share repurchase program running from October 2026 through the end of fiscal 2028.
$2 billion. That is staggering.
Right. I mean, authorizing a $2 billion buyback when your normalized free cash flow is approaching $1 billion annually, that means you are committing a huge percentage of future cash directly to share retirement.
You don't do that unless you are incredibly certain.
Exactly. How can a board be that certain of their cash position 2 years out?
The certainty stems from a specific SAW accounting metric they emphasize heavily.
Deferred ARR.
Yes, deferred annual recurring revenue.
Break that down for us.
When PTC executes the strategy, displacing competitors and locking in customers who need this data foundation, they're increasingly signing longer duration, multi-year contracts. A customer migrating their global engineering database to Windchill isn't signing a 12-month pilot. They are locking in for 3 to 5 years.
Because the software is sticky, The switching costs are astronomically high. You don't just casually rip out the central nervous system of your engineering department.
Precisely. Now, accounting rules dictate that PTC cannot recognize all the revenue from a 5-year contract on the day it is signed.
Right, you have to spread it out.
It must be amortized over the life of the agreement. So the contracted, legally guaranteed revenue that has been signed but not yet recognized accumulates as deferred ARR.
Okay.
And locking in those longer contracts in Q2 created a massive swell of this deferred ARR.
So it gives management incredible visibility into the second half of the year.
It drastically de-risks the lower end of their guidance range. The $2 billion buyback isn't a speculative gamble on future sales.
They are looking at a ledger of guaranteed cash flows that have already been contracted.
Exactly. They know exactly when those payments will hit the bank account over the next 24 months.
That is a phenomenal setup.
It really establishes a hard floor under the equity evaluation.
Which brings us to our outro, the bottom line. The data is clear, the narrative is holding together, and management is putting literal billions on the line.
We need to deliver a final verdict for the listener's portfolio.
Right. And I think we both take a decisively bullish stance on this one.
Oh, absolutely bullish.
The go-to-market restructuring is firing on all cylinders. They are actively displacing competitors, like with Codebeamer at Hamilton Medical.
And that AI modernization tailwind is proving to be a highly lucrative multi-year catalyst.
So, actionable takeaways for you listening. If you are currently holding the stock, that new $2 billion share repurchase authorization provides a massive floor.
Right. Massive downside protection for the next 2 years.
Exactly. And if you're considering the stock, you really need to view PTC not just as old school industrial software, but as a backdoor infrastructure play.
As the world scrambles to physically build out AI data centers, those builders rely on PTC's software to engineer the hardware.
But we always like to leave you with one strategic risk to ponder on your own.
The provocative thought.
Right, because PTC's entire long-term vision rests on their proprietary AI agents dominating the engineering ecosystem, right?
Who relies on that walled garden?
Exactly. But what happens if the broader AI industry pushes for radically open, interoperable 3D data formats?
This is a huge debate right now.
It is. Think about OpenUSD, driven by NVIDIA Pixar, trying to create an open framework for 3D data.
Right.
If an open source AI eventually learns to parse geometric manufacturing data without needing PTC's specific software environment, does PTC's unfair advantage suddenly evaporate?
It's a fascinating technological arms race.
It really is. A closed, physics-aware ecosystem versus generalized, open standard AI.
Definitely something for the savvy investor to watch closely over the next decade.
Well said. That's all for today's deep dive. Thanks for listening, and we'll catch you on the next Talk Tickers edition.